Joining us today is Matt Johnson, Managing Director with the McFarlin Group. We're personally very excited to welcome the McFarlin Group into our Global Wealth Group portfolio of sponsors. Matt will be speaking with us today about his personal background, career experience and lessons learned, as well as a bit more about the McFarlin Group as an opportunistic senior living investments firm. I think that's right. The best way to describe it, correct, Matt?
You are correct.
Okay, excellent. So Matt, thank you so much for joining me today. I appreciate it.
No worries. Thank you. And Happy New
Great.
Year.
Happy New Year to you too. So Matt, if you could just open with giving us a bit more about your career background and how you became a part of the McFarlin Group.
Great. Thank you. So McFarlin was formed in 2008 by me and a few partners who worked together previously at a predecessor company in the industry. And so my two partners and I have known each other since 2001. And the three of us combined, which make up our investment committee, have around 59 years of experience in senior living. So we've all been in senior living almost 2 decades, each of us. And it was with that experience that led us to start McFarlin Group in 2008, and principally started as a developer and owner of assisted living and memory care properties, initially in Texas and then expanding outside of Texas. And we've now migrated and pivoted into multiple continuums within senior living, so active adult all the way through skilled nursing. And in the last 2 years, really pivoted the business to change our focus from development, as we felt the markets were overbuilt here in the US, to acquisition, and really now with our current fund vehicle focusing on deeply distressed senior living properties that really got caught in markets that were overbuilt. And so that's our current focus.
Okay, brilliant. And I actually want to
Sorry.
I've put mine in the room, otherwise they would be doing the same thing. I actually want to jump into senior living as an asset class and just why you have worked in senior living before we move into the kind of lessons learned in your career, if that's okay. I think that makes more of a natural.
Yeah. So my first job out of school in 1998 was working at a large accounting and consulting firm called Deloitte and Touche, and really enjoyed real estate as I was buying and fixing up houses on the side back in 1998, 1999, and learned about an opportunity in senior living. And as I learned more about the senior living space, as it was relatively new to me, became very interested in it, principally because of elderly grandparents that lived in senior living facilities, and dealt with an aging grandparent who stayed at home as long as he could, developed Alzheimer's, dementia, and our family was kind of unaware that there were all these great options out there for our grandparents, which we didn't utilize. And then also learning about the baby boom population and how they will have a considerable impact on the senior living space, which hasn't even occurred yet. And so for all those reasons, I joined a pretty large senior living firm based here in Dallas in 2001. And they were developing properties all across the US, size range from 30 million to over 200 million. And again, that's where I met my partners, but we really all developed a good pedigree, learning the senior living space before we launched off to start it on our own. And we all have a passion for what we do. And I think that's important in senior living, is that it's a tough business. It's an operating business, unlike owning a triple net leased industrial building. And you really have to have passion for it. And also, we believe that you have to have specific focus because it's such a unique business. It has a hospitality component like a hotel, a healthcare component like a hospital, and a housing component like a multifamily community, all wrapped into one. So we believe that it needs, and in order to maximize value for investors, that it really requires a group to have specific knowledge and focus in senior living to maximize value. So we don't focus on industrial, retail, office. We solely focus on senior living and healthcare.
That's great. And I think, well, I imagine having that personal experience of putting a loved one, having to navigate that process for a loved one definitely gives you some greater perspective when as an operator in this business. So
Absolutely. It gives a personal, a human element to it. And I love going into buildings that we own and or operate, as it's like being in a building full of grandparents, and they have, the greatest generation. They have certainly so much life and so much knowledge and experience. And so it's really rewarding. And for me, my partners, and all of the 400 employees in our organization are very passionate about what they do.
that's great. Over the time that McFarlin has been established and just your 2 decades of experience, what have been some of the lessons that you've learned dealing specifically in this asset class?
So we have a lot of scars of experience. Now that we've been in business going on 13 years, and developed around 15 to 16 properties, and successfully sold 12 of those properties so far. We have around another 10 properties in our portfolio. So we have a lot of lessons learned and scars of experience. I'd say a few of them. Number one, we've learned that our due diligence process is the most important process that we can go through. It all starts with a solid foundation, just like building a house, that if your foundation isn't solid, the rest of the house will not be built in a solid manner. So we really focus on due diligence, and using a military term, prior proper planning prevents piss poor performance. I think that's a Marines term. And so we spend a lot of time in due diligence and planning to ensure that we're making good investment decisions, and that we don't get emotionally attached to a deal ever. We kind of think of it as a series of stoplights, and we keep moving forward with the deal as long as we have green lights. And we get a yellow light, we slow down and do more analysis. And if we hit a red light, we stop and put pencils down. In our track record, which we've returned a 28% IRR to investors on 12 properties that have gone full cycle. And we are working with an accounting firm, an auditing firm, to actually certify our track record, which will hopefully ultimately be available in a data room. We have one property that was not successful. The returns for that property are included in our aggregated IRR, but there were a lot of lessons learned just with that one property. And as I tell my 3 boys, you learn a lot more from your losses than your wins. And we took a step back and analyzed what happened with that property. And that's really is a development deal in San Antonio. And the experience from that property, Gabriella, pivoted our business from development to acquisition, as we learned that many markets across the US were way overbuilt for senior housing, and San Antonio being one of those markets. And so the properties couldn't lease up, they run out of working capital. And so we really, at that point in our career in 2018, pivoted the business to focus on distressed senior living acquisitions, as we felt like the markets were overbuilt due to a lot of migration into senior living from other developers, from hospitality, healthcare, and multifamily, chasing the strong yield profile that senior living properties can create for investors, as well as the aging demographic trend led by the baby boomers. And for those reasons, we really overbuilt the space in most markets across the US.
Interesting. And given that this is an asset class where demand, I think, may always exist, and you are kind of following the populations as they age into this demographic that is, very specific to this asset class, do you foresee that kind of overdevelopment will ultimately find a place in the market over time?
Yeah, in our detailed fund deck, we have a few slides in regards to the aging population and what the future holds. COVID has undoubtedly um, increased the amount of distress in the senior living space. We believe there was distress created prior to COVID, and now COVID has deepened that distress by declining occupancies. And when occupancies decline, more working capital is required because it's an operating business. Lenders don't get paid. So I think in the interim, there will be more distress for the next 18 to 24 months. And our occupancy recovery in senior living won't be a V-shaped recovery. It'll be more like a swoosh, and therefore it'll create distressed buying opportunities for us for the next 24 months. But the age wave, the senior tsunami, the graying of America is really unprecedented in US history. And the oldest boomer turned 75 on January 1st this year. The youngest boomer is 57. So we have a long period of growth ahead of us, really starting in around 4 to 5 years, which is when we believe it'll be a good time to be a seller. So buying at discounted prices today, adding value over a 4 to 5 year period, aggregating and selling just as the boomers are turning 81 and 82 and giving a lift to occupancies in senior living. Within our fund deck, we kind of describe the aging population. And in about 5 years, when the boomers are turning 80 and moving into senior living communities, specifically assisted living and memory care or Alzheimer's communities, the demographic trends really present a 30-year trend of increasing demographic profile of our typical customer, which many believe we won't be able to keep pace with the demand through development during that 20 to 30 year period. So it's kind of an interesting dichotomy of we're in a distressed, overbuilt situation right now, but in a pretty short period of time, in 5 to 6 years, we will start a 20 to 30 year trend of strong need for senior living. And
Mm-hmm.
certainly technology will play an important role in senior living communities, but also allowing seniors to stay at home, possibly a little bit longer. But with the incidence rate increasing for Alzheimer's disease as seniors live longer, and as Alzheimer's disease develops, it's really hard, even with advanced technology, to care for a loved one at home in our home environment or keep them at their home if they are a wander risk, they may have behavior issues. So it's really hard to care for them in a non-institutionalized setting. So for a number of reasons, which we describe more in our full deck, which will be available on your website, we describe a little bit more about the aging population and its long-term impact on senior living.
Great. And you touched on distressed assets. Could you speak to that a bit more as it relates to kind of where this asset class is at the moment in the market?
Yeah, so they say in real estate, you make your money on the buy side, not the sell. And we're using that strategy right now. We are focused on buying underperforming or non-performing properties that were ideally built in the last 5 to 10 years in the top 50 MSAs, metropolitan statistical areas in the US. So more major markets, focusing on new developments that were built in overbuilt markets they couldn't lease up. And then COVID has declined occupancies. And we're focused on buying those properties with a additional focus on buying the loans from the lenders on those properties at some discount to par, and then foreclosing to own the properties at great discounts. So we're getting in at incredible discounts and low basis compared to cost, and then aggregating those properties over a 4 to 5 year period, and then selling in one or more regional institutional portfolios across the US. Our typical property, Gabriella, is a combination of assisted living and memory care, or possibly a standalone memory care Alzheimer's, or even some independent living properties. So we'll look at anything in the continuum of care to acquire. We are certainly trying to get the best discount possible. And in order to do that, we've raised over $100 million for our prior transactions. And we've done that on a deal by deal basis. But what we've learned is when you're buying distressed properties, we need to be in a position to close quickly. And the sellers, which could be a lender seller or a sponsor owner seller, that what they look for is a quick close and certainty of execution. So we found the best way to do that and be a credible buyer and be able to close quickly without having to go raise money deal by deal is to structure a fund which will allow us to close quickly. The benefit for investors in the fund is that a singular investment will be spread across 10 to 15 different assets, possibly more, and therefore they'll have diversity in terms of geographic diversity across the US, some product diversity, some independent living, some assisted living, some memory care, but also the total number of investments. The best, to use a sports analogy, the best quarterbacks out there, like Drew Brees, doesn't complete 100% of his passes. He completes 75, hopefully 80% of his passes. So we kind of look at things the same way, that not every one of our 15 properties that we will acquire in the fund will perform to our underwriting and expectations, but we expect that 80 to 90% of them will. So that diversification in terms of total properties, I think, is a positive for investors.
That's great. And for someone who's looking into senior living as an asset class and distressed property, investing in a fund of this nature, who is that individual? What does that investor look like? Their profile, do you believe?
So we've successfully raised a lot of money in the past from high net worth individuals in denominations of $25,000 to $100,000. And it's really difficult for those investors to invest in this space in smaller denominations. And so that's kind of the typical profile of our initial investors in the fund, is high net worth individuals, investing anywhere between $25,000 to $250,000. We have several investors currently in the fund and several more that we're talking to that are family offices, single family or multifamily offices that are investing in larger increments, and a few institutions that are even at larger increments. But I'd say the profile of our typical investor for this is a high net worth individual that really can't invest in this asset class outside of maybe a mutual fund or buying bonds. So this is kind of a unique investment opportunity for high net worth individuals that generally don't have access to these types of investments unless they're putting up several $1,000,000 in an investment.
Right. And is that type of investor someone who's invested in your independent or individual development deals, not necessarily this fund that we're discussing now?
Yes, we have a number of investors that have invested with us in the past in developments, in other distressed acquisitions, who are also invested with us in the fund. And so we are not raising money right now on a deal by deal basis. So all of our capital raising efforts are for the fund, and all the acquisitions and distressed properties that we acquire, we will invest through the fund. So we won't be cherry picking deals and have some deals outside of the fund and some inside. 100% of our transactions will be going through our fund, so that all of our investors will be participating in all of the deals going forward.
That's great. You touched on the importance of due diligence for the McFarlin Group. Can you talk a bit more about the process of due diligence that you do follow?
Yeah. So it starts with number one, identifying the property. And then we dive into market analysis. We want to understand where the site is, what are the demographic profile of our customer within a 5 mile, 7 mile, 10 mile radius, or even a drive time, a 10-minute drive time or a 15-minute drive time. So we want to understand we know who our customer is. We want to understand how many potential customers, our total market opportunity within our market area, and then understand the competitive environments. How many competitors are there? What is their occupancies? Are they offering concessions? Have they been increasing rents? Is there anything under construction or anything in the pipeline that we need to be aware of and take into consideration? So that's the first step that we take. And that's really the solid foundation. We can't buy a building and pick it up and move it to a new location. So we're stuck with any location when we buy a building. So we first focus on the market opportunity. Second, if we get a green light and move forward, we start diving into the physical plant of the building. What is the age of the building? We generally know that newer buildings have more stringent codes in terms of building codes and regulatory codes. So it gives us a little bit more comfort that the quality of the building is more secure and better for us and our investors. As the building has a more advanced age, we certainly need to spend a little bit more time understanding the roof systems, the HVAC and other things to make sure that we're not buying an older asset that's going to need a lot more working capital than we expect. And then focusing on the loan documents. If we're buying the loan, we want to make sure that we have a secured position in the property. There is no other third-party liens on the property, and that we have a clear pathway to take title and ownership to the property. We do that internally, and we use third-party counsel to help navigate us through any loan documents to again ensure that we have a clear pathway to take title. If we're buying the real estate direct, we still involve our counsel to help underwrite title and survey to make sure that we're buying an asset that doesn't have any hair on it that we're not aware of. So those are the critical things that we do during due diligence. And then our investment committee meets many times per week. So we're continually talking about the transaction as we move forward. As I mentioned, this stoplight program that we continue to get green and yellow lights. And as long as we get green lights and move to the finish, then ultimately we'll take a deal to credit committee for final approval. And we generally have to have unanimous approval from the three credit committee members to move forward with the transaction. And we do that so that we're all 100% committed to a transaction that we invest in. And then we also have our own money invested in the deal. So it's important for us. It's important for investors as we have alignment through our investment of $5 million in the fund that we're making a good investment decisions, not only for our investors, but also for ourselves. So once we get 100% approval at credit committee for the final time, then we move forward with closing.
Great. That's extremely thorough. So thank you for that run through. I want to ask, I think I skipped this question. How does senior living add diversity to an investor's portfolio?
I'm sorry, can you say that again?
Sure. How does senior living add diversity to an investment portfolio?
Sure. So a majority of our prior investors, Gabriella, certainly have money invested in equities, but it's hard for them to add real estate exposure to their portfolios. And so I think a lot of investors are moving towards other platforms where they can invest in real estate transactions. And so we found that our investment in the fund offers investors a unique avenue to really diversify their investments. And that's the way I personally think about it as well, that I have a managed portfolio at JP Morgan, but I also invest in real estate through our company. And I like the diversity that it offers. As here in the US, we're putting forth a lot of funds for the pandemic, and our total debt as a country is increasing. We're keeping interest rates low. So I think in the future, we'll have greater inflation, and real estate has generally benefited from inflation. So I think real estate is a good investment in the current market where there's potential inflation. And it's a nice diversification for investors outside of being invested in equities. We're really non-correlated to the stock market. So if the stock market, goes down for whatever reasons, our values in real estate and senior living generally aren't decreasing with the stock market. They're non-correlated, and generally, we're increasing and adding value year over year, as well as inflation giving a lift to values of our properties as well.
Definitely. And I think senior living is an interesting asset class because it is kind of a combination of medical and residential. And I mean, I think there's a third or maybe even fourth type of asset class there that you can say is a combination. The combination of all of those together is senior living. So even as a type of real estate to invest in, um, gives you, I think, a bit more of a dynamic investment opportunity
Yeah,
there.
yes, no, I would definitely agree. I think a lot of our investors feel that way as well.
Great. Um, Final questions. Why our marketplace? So what led you to be interested in the Global Wealth Group? What are you excited about being a sponsor? Or what is it that excites you about being a sponsor on our marketplace?
Yeah, Gabriella, as I learned more about global wealth, and your broad reach to investors and accessing a group of investors that we don't have knowledge and awareness to, and so being able to offer something to you and your investors, and broaden our reach and offer something that is a little bit unique with a niche focus on senior living. And the global wealth platform, I think, is unique and growing with a investor audience that is very synergistic with our current investor audience. So I think the new investors that global wealth would bring into our fund is a nice complementary match with our current investors. So I think there's a lot of synergies in working with global wealth for our fundraise.
Great, thank you.